In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency, data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG.
Terrific. Good afternoon, everybody. It is terrific to be with you here in Zurich, and welcome to this Reuters Newsmaker event. My name is Erica Bourne, and I'm the Chief People Officer for LSEG. And it's an honor to welcome an incredible leader in global finance, Sergio Ermotti. Sergio Ermotti. My apologies, Sergio. As everybody here knows, Sergio is UBS Group CEO and President of the Group Executive Board. Sergio is successfully steering UBS through the Credit Suisse integration, and as we saw last week, returned the combined business to profit within a year. It is particularly special to be introducing this session today. Our organisations share a great common ground and a strong commercial partnership. I know the data and analytics team at LSEG is supporting both the integration and continued growth strategy at UBS. And LSEG is a client of the firm and expanding that partnership further. Both companies have recently worked through major acquisitions and the integration activity that follows ongoing. I'm particularly looking forward to hearing Sergio's perspectives on this in today's session. And on a personal note, if you turn the clock back a little further, LSEG benefited from Sergio's expertise as a member of our board for a number of years. Our partnership is a reflection of the client-centric approach which runs deep in both firms. And I know I can speak for everyone here when I say we are very fortunate to have you with us today, Sergio. Thank you.
Thank you.
Now turning to Elisa Martinuzzi, who joins from our host Reuters. Elisa is Reuters editor of EMEA Finance and Markets, and we're leading the conversation. I know you have been a leading voice on European financial markets for over a decade and covered Credit Suisse and UBS in depth for years. We are all looking forward to the conversation, so I hand it over now to you to take it away.
Thank you very much, Erica. Thank you to everybody in the room. Good afternoon and good morning and evening to those who might be tuning in remotely. Sergio, thanks very much for joining us for this Reuters Newsmaker event. Now, according to your chairman, you have the toughest job in financial services globally. And we're about to find out as you steer UBS through new banking regulation, a very complex business integration, higher interest rates for longer, and heightened geopolitical risks. So a few things on your to-do list. But before we dive right in, I thought I'd just give a few remarks, a brief introductory on who you are, of course. From aspiring footballer to banking apprentice to running a trading business at a Wall Street firm, Sergio's ascent in banking saw him join UBS for the first time in 2011. And within months, he was named CEO and entrusted with rebooting the bank after a rogue trader had cost it billions. Now, in the 9 years as CEO, he scaled back investment banking, pivoting to wealth management, a model which, of course, many rivals have since mimicked. And he left the bank soon after steering the institution through the first wave of the pandemic at the end of 2020. He joined Swiss Re as chairman, but it wasn't long before UBS turned to him again. As we all know, in March last year, just hours after UBS swept in to rescue Credit Suisse, he got the call. He was needed as CEO again to execute the biggest banking merger since the global financial crisis. And here we are, a little over a year later. I thought we might start by speaking a little bit about Switzerland. I mean, it went through a tumultuous few weeks, few months, at one point finding itself very much at the center of what could have been a second global financial crisis. Now, Eurovision victory at the weekend may suggest that Switzerland has its mojo back. But to what degree would you say that it has recovered as a financial center from that big blow?
Well, actually, very well. I mean, I think that I'm taking not only anecdotal evidence, but also of how we do as a financial center in the last 12 months, but also when I go around, visiting our operations in the US, interacting with clients, regulators, policymakers, many people, I think that the regard for both UBS and Switzerland on how he addressed this problem during the weekend, it's quite important and remarkable. Of course, probably we didn't cover ourselves with a lot of glory in what led this situation to happen, but I do think that the actions taken over the weekend demonstrated the strength of Switzerland. I can only tell you that I remember very well in the few weeks following the rescue that many observers and commentators and market participants would say that Switzerland would be a pariah in capital markets. We would never be able to access any funding, any AT1 bonds. Actually, 7-8 months after the event, we were able to issue 3 billion of AT1 bonds, attracting 36 billion of demand. In my point of view, that was the ultimate testament, not only to UBS, but also to the fact that Switzerland has a credible role to play in our global, in the global financial system.
But you described the situation, as quite embarrassing, I think, in your own words, not ideal, tragic. Yeah. And you just said, things didn't go quite so right leading up to it. So what still needs fixing to your mind?
As I said, we didn't cover ourselves with a lot of glory before, and I do believe that in order to understand all the issues that needs to be addressed going forward, a proper post-mortem has to be done. So I think that there are many things that should be addressed. It's not only me. I mean, there are experts. There are even parliamentary commissions that is looking into the matters. It's very, very important not to allow this debate to be moved into forward-looking demands or solutions that takes away the responsibility and the accountability everybody has to respond to in respect of what happened.
So one more question, if we may, using our rearview mirror. What surprised you most about Credit Suisse now that you know it better, having seen it with closer eyes?
Look, I think that I'm not surprised because I always recognize a lot of the strengths of Credit Suisse franchises, both in terms of business people, capabilities, and in that sense, I'm surprised the way, honestly, that we probably have been able to anticipate and execute much faster than I thought the integration of the people within UBS. I think that it was painful for many of them. I do recognize because it was very emotional, for different reasons for many of our new colleagues. But I'm surprised to see how quickly we are now working and acting as a bank. And actually, I'm really looking forward to see the integration of our parent banks that is due to happen now at the end of May, because that merger of the operating banks is going to de facto take away the internal narrative UBS Credit Suisse. So we're going to be also from an operational and legal standpoint of view, one bank. Today is still two banks. Somehow psychologically still not easy, but I'm very positively surprised how quickly we are now managing one bank together. And so much that I say when I look at our achievements in 2023 and also in the first quarter of 2024, the ability to, what I'm most proud of, and all of us are proud of, is the ability to execute on the integration, and at the same time, people are focused on serving clients and delivering results. This is not an easy task.
But tell me a little bit about the cultural integration. I mean, how is that playing out, from within? How's that playing out within the teams, would you say?
Well, that's, I think, I mean, look, there is not so much dissimilarities. I think that, first of all, I have to tell you that the cultural issues that we are discussing, there is always a fairly negative connotations, but I do think that Credit Suisse and UBS shared already a lot of common values, common views on how to run businesses. And also, at the end of the day, let's be frank, people are de facto always following what they feel they have been told to do, top down, right? Or what they believe people above them wants them to do. So the integration was made very easy because from the very beginning we said we are open to listen to different views, but one thing is clear. The operating model we're going to adopt is the operating model of UBS. The systems are largely going to be UBS system, processes are going to be UBS system. So in a sense, while maybe frustrating, we also clarified from the very beginning what we stood for and how we want to run the business.
Fair enough. Which segues very nicely into my next question. So you've described one of the biggest risks going forward as being the integration of tech, of IT. And we've known, large corporates, this is often a headache. In the banking industry, it's been quite painful. You don't need to look any further than Deutsche Bank, which has paid, very dearly for trying to integrate Postbank. I'm curious to understand at this juncture, where you're getting very close to going through that integration, what have you learned from those mistakes? And where could things go wrong?
Well, I mean, look, we are about to, two of the major risks for the integrations are now the regulatory approval process for the mergers of the parent bank. We are going through the approval with 70 regulators in 50 countries globally. So I think that's hopefully is going to be resolved in the next, by the end of May, and then so we can execute on that. The second one is, as you mentioned, is the IT. The way we try to mitigate that risk is to, first of all, we are planning with the appropriate timeline, but also, as I mentioned before, we made a clear decision that by integrating only 300 applications of Credit Suisse out of 3,000 applications. So i.e., we are really reducing the risk of IT integration risks and moving the risk, which is also not a small one, to move clients into our platform. So it's more a data issue than it is a combination of IT platforms. Mm-hmm. So
in this data issue, what could go wrong? What are the sort of the scenarios that you plan for?
Well, we are testing and making sure, first of all, that we look at not migrating data that is not necessary. That's a very big issue. I mean, we are sitting on a lot of data. I can't even remember how to describe it in technical terms. It's so huge, right? So
but
it's very important for us to really make sure that we don't create unnecessary risk is migrating data that is not necessary, and that brings complexity and risk. Now, I'm pretty convinced, we are pretty convinced that our real risk is a delay rather than are we able to execute or not. Mm-hmm. Delay as a consequence, because delay is probably not so impactful for clients, which is the most important issue to achieve for us, is to make all these migrations as smooth as possible for clients. It's almost impossible to pretend that clients won't see it, but we really want to minimize the impact on clients. The second issue, of course, is delays means
profitability.
Cost, right? So for us, the real risk is to have to delay the realizations of synergies. Mm-hmm. So in that sense, of course, we need to plan and to be credible in what we do. I'm confident that we are moving in the right direction, but we are not complacent. That's a risk.
And on the time frame, believe you're aiming to decommission about 30% of the apps this year. Is that still on track?
Well, 30% is probably the maximum because really we can't really decommission application before clients are migrated. So I mean, it's a real. The migration starts toward the end of this year. Hopefully, we're going to start to migrate wealth management clients in Hong Kong, Singapore, and Luxembourg. De facto, the IB clients have been already migrated. Or they will finish in the next few months the migration from the CS platforms into the IB platform of UBS. Next year, we're going to start to migrate the Swiss clients into the UBS platforms. So it's going to go on until the end of 2025 into the early part of 2026. And then in 2026, we shut down systems.
And tell me a little bit about, the cost associated. I mean, I've seen, ranges from 1 to 3 to 5 billion. Can you help us with a sense for how much this is going to cost?
It would be good if it's only 2 or 3 billions.
It'd be good for just 2 or 3.
It's 13 billions. I mean,
no, I'm talking about just IT.
Oh, the IT, but I mean, the vast majority is people, but cost to achieve for realizing our 13 billions of cost savings, including our is around 13 billions. So, so of course, well, first, then there is also the write-down of systems that we had to take, impairments of goodwill on systems and so on. So it's meaningful, yeah.
You mentioned the cost savings, and of course, part of that is going to be reduction of personnel. And I know it's the one question that you might not want to put a number on, but I'll give it a try anyway. So some of the numbers that have kicked around point to, the number of employees at the end of the transition around the 85,000 mark, which would be, compared to 74,000 before the merger. Does that sound like a trajectory that's reasonable?
I'm not going to comment on those speculations. I'm only telling you that we need to save 13 billions gross. We're going to reinvest to make our systems, our processes, our businesses stronger. It's a painful exercise. The way we achieve the cost reductions in our industry is inevitable. It's coming through headcount reductions, particularly in a case in which you are not only trying to get synergies out. First of all, we need to remember that we had to restructure a gone concern bank that needed to have a restructure. I mean, it's two processes: a restructuring and then looking for synergies. So now, the painful process, because it's the most difficult part of the job, is the one related around people. Because that's the reason I don't want to answer that question, because I understand it's very nice for you guys to talk about headcount reductions all the time, but it's very painful for
It's
people.
not nice, by the way.
No, but you like it. So in any case, so for us, it's about how we minimize this issue by taking in consideration natural attrition, people retiring, mobility internally in the organization, early retirements. We're going to also count a lot on, both UBS and Credit Suisse. We used to, particularly in the IT and some back office services, to outsource many of the jobs. So we're going to try to internalize as much as possible of this. So reducing the amount of proactive redundancies we need to do. So the outcome will be a reduction, because it's inevitable we need to reduce headcount, but hopefully we will do it in a way that is also manageable. And by the way, as I mentioned before, we still need to run 2 systems, 2 banks for the foreseeable future. So it's not a sudden effect. Well, now, some people may say it makes it painful because there is no certainty, but we try as much as we can to be clear with people about how things goes.
So it's somewhat related to this. I wonder if you could tell us a little bit about what your thinking is on generative AI and the impact that it has on, in the sort of medium term, potentially on productivity, and how much sort of thinking have you done about this that you can share with us, perhaps?
Well, look, I'm not an expert on the topic, but now I'm getting up to speed with some elements of that. And but when I look at two dimensions, if I look at many of the processes that we have in our businesses, in a bank of the size of UBS or Credit Suisse or any large institution nowadays, you would wonder, why do we need so much human intervention, so much it's not just an issue of cost inefficiencies. In many, many cases, as we are faced with exponential growth of data and transactions, it's also very difficult to keep quality of what we do. So I do hope and think that technology, and in that sense, any kind of artificial intelligence or advanced technologies can help us to become better, not only more efficient, but also more effective in the way we operate. So according to, experts, I mean, if we expect any business every year to create efficiencies of around 1% in how you operate in a normal stage, I believe that enhanced technology can help us to probably multiply that by 3 to 5 times in the next 5 years. It's not going to happen in the next 5 months, but over time, I'm convinced we're going to see the effect on our industry, both front end, but also back end.
And this could be said about any merger, of course. You're busy with a very large integration, but to what degree? I mean, what's the danger right now that you're missing the focus on generative AI, which a lot of other businesses are paying a lot of attention to, and that you're going through an integration that, before you know it, maybe you would have done differently if you could only have waited a couple of years.
Yeah, that's the risk is there, but but we are aware of that risk. I mean, as I mentioned before, so we are very proud about being able to achieve, at least for the time being, 2 things: one, integration and serving clients. But of course, the agenda is there. We already run 100 AI advanced technology projects, half between front and back. So we are on top of it. Of course, the competitive landscape is changing very fast, and we know that we need to make sure that at the end of the journey, which is the most important topic, also going back into your topic of headcount and growing, at the end of the day, we want to have a better growing version of the UBS of 2022. And therefore, it means being able to compete not only for the best people, but also giving them the best tools to be successful. And technology is part of the equation. When I said we're going to save 13 billions, I said we're going to reinvest part of this, few billions, for making our processes and our businesses stronger. And this is what I mean.
Sure. So I would be remiss if I didn't touch on the topic of whether UBS is too big for Switzerland. Balance sheet of around $1.7 trillion, I believe is about twice the size of the Swiss economy. And from the OECD to the IMF to the Financial Stability Board, they've all sort of raised concern about the potential size of UBS relative to the economy. And some of that might translate into requirements for higher capital. Obviously, you reported earnings last week, and you gave some guidance for 2024, 2026 in terms of how much you'll be able to return to shareholders with a view of generating more capital. But I'm curious to understand, what the outlook looks after 2026 based on some of the numbers that are kicking around of capital that you might be asked to set aside, of larger amounts of capital that you might be asked to set aside. I think the finance minister talked about 15 to 25 billion in the context of the too big to fail regulation. Can you help us understand a little bit about the capital return trajectory in that context?
So you touched so many topics in that long question that
Okay.
I mean, let me first of all, not go away from the topic that, once again, I don't believe that we are too big for Switzerland. I think that while I fully understand that an easy to compare statistic is our balance sheet versus the GDP of the country, I would say that when you look at other data points, not only in respect of the bank, but also the Swiss economy and what we do, you would easily see that Switzerland is a country that punches well above its weight on many dimensions. So, but let me first talk about our risk and our balance sheet. We have around 550 billions of risk-weighted assets. I do think that when somebody wants to look at the size of our risk compared to the GDP, at the very least, there must be some intellectual honesty in putting different data points in comparison. And when you look at our balance sheet, which 15% is cash, 20% or more is mortgages in Switzerland, you break down our business model, it's very difficult to understand why we would be such a big problem. If I look at the balance sheet of our central bank, is also pretty high compared to any other countries.
That's for a separate conversation.
No, but I'm just talking about how, if I look at the per capita wealth of the Swiss citizens is multiple of our neighbor countries. If I look at many dimensions of the Swiss reality, Switzerland is an economy and is a country that, as I said, punches well above its weight in economic and financial terms. And we need to make a decision. What do we want? Do we want to have that kind of wealth creation in our economy, or do we want to let other people's narrative influence what we need to do? I stop here on that. So,
but there is a regulatory push.
It's exactly what I said at the beginning. What we need to do is to make sure that people go and deep and really understand what happened, why it happened, before we jump into conclusions.
And that's going to feature in the debate, is it not, in the parliamentary debate?
Now, in respect of any calls for more, by the way, there was a very extensive report by the Swiss Federal Council. We agree on the vast majority of what has been proposed. There is a need to fix some issues that were issues created, also by the lack of intensity and desire in fixing or bringing the Swiss standards in some aspect of, for example, public liquidity backstop or resolution regimes, to be up to speed. But having said that, when you talk about the only areas where we believe it's appropriate not to overshoot is the areas around capital. I'm not going to respond to speculations, and I'm not going to speculate about what is right to be done or not. The only thing I offered last week is a fact. As a consequence of buying Credit Suisse, UBS will absorb 20 billion of more capital requirements. That's a fact.
Right, and that's in your plans, right, in terms of the trajectory for returning capital to shareholders beyond 2026. But what if there's an additional 10 billion?
I'm not going to speculate.
Okay, I've got to ask.
I'm not speculating on this because we don't know the basis for any of this. It's a very complex topic, and it's definitely not something that can be so addressed in a couple of sentences in such a forum.
But sticking with the regulatory landscape, in the past you've said that staying in Switzerland for UBS, this is when you were previously running the bank, isn't something that we should take for granted. And Swissness needs to be a competitive advantage. Now, if that were to change, would you consider looking elsewhere?
Elisa, I never said that. I responded to a question. No, that's not what I said. Because somebody, maybe it was you, asking me another question. It said, I answered, can you exclude? And I said, who I am to exclude some things. Okay? That's a very different statement than saying that Switzerland or anybody should take us for granted or not for granted. What I can say and reiterate what I said back then, Swissness and Switzerland is a core value around UBS strategy. And we believe that not only UBS and its shareholders and employees and clients benefits from it, but also the country benefits for it. And I believe this should be maintained going forward. But I'm nobody to say if things are going to be that or not, because this is not in my control. I only know what matters today. We benefit from it, and Switzerland benefits from it.
But if that were to change, would you
Change of what?
If the being in Switzerland became an impediment to, say, bridging the gap with your US
That's
peers?
an hypothetical question. So I don't answer hypothetical questions. So the only issue I know is that Switzerland benefits from having a strong financial system. A strong competitive UBS is part of that equation, and UBS's stakeholders also benefits from being a Swiss-based company. That's the fact. So hopefully people can, and everybody can recognize of the mutual interest of keeping that situation.
Now, let's talk a little bit about strategy and growth. The deal, if I'm not mistaken, the combination with Credit Suisse added something in the order of 7 to 10 years worth of organic growth. And by 2028, you're aiming to achieve invested wealth management assets of around 5 trillion from what, 3.6 now, around about?
4 trillion now. 4
trillion now. And your net, the growth per annum is going to significantly accelerate after 2025, 2026. How's that achieved, would you say? How's that extra growth going to be achieved? And are you sacrificing some of that in the interim?
We do by, in wealth management, we aim for 2024, 2025 to grow net new assets at around 100 billions a year. And then from 2026 around 200, going up to 200. The reason why is because we believe that the integration of Credit Suisse brings also the dilemma of how to manage growth with sustainable returns. In a sense, one of the things that we needed to restructure was not only the cost and the risk profile of certain businesses, particularly when combined, but also the returns on assets that Credit Suisse had in its businesses. They were half of what UBS had. So return on risk-weighted assets at Credit Suisse were half of that. So as we now manage the integration, we need to focus on making sure that resources are properly compensated for the risk we take. And as I said, we're not going to hit trying to go higher than what UBS was standalone. Actually, our aim is to narrow the gap in the foreseeable future in making those assets more aligned with our return aspirations.
And speaking of returns,
and that's the reason why you need to accept less growth, because of course repricing repricing businesses is not always easy, and it takes time, and in some cases you may even think clients may not accept it, right? So
and speaking of profitability, some analysts argue that while there's such a large gap in margins in the US between yourselves and your peers, Morgan Stanley, for example, the valuation gap in the market value should persist. How do you narrow that gap in margins in the US? How do you do that?
Well, I think that we are now, first of all, let me tell you that it's almost like saying, with all due respect for our competitors, it's almost like we're probably never going to close the gap to them in the US, and we can aim to narrow the gap, but it's almost like in the foreseeable future, I don't see how our competitors can now close their gap in their international operations compared to ours. So that's a starting. So each of us has different strengths and areas of improvements. So, and that's the starting position. In the US, we are investing in making our capabilities, particularly in institutionalizing our wealth management clients more. So that means offering a broader range of banking products, credits on deposits, on covering a broader range of clients, particularly in the family offices, working closer together between the IB and wealth management. It's particularly important now that the excellent capabilities that Credit Suisse brings on banking, M&A, and capital markets in the US, combined with our existing one, has created a framework that allows our financial advisor and investment bankers to talk more about client relationships holistically. Some things we do more in Europe and Asia. And that's the reason we are very successful. So I'm convinced this is going to allow us to narrow the gap in the US.
And is M&A a solution to that? Are there businesses that you could bring in?
At this stage, I mean, look, I don't think that our industry can basically say no M&A, never M&A. At this stage, we need to really focus on integrating Credit Suisse. Is really a major issue, so we cannot be distracted by other things. I don't want people to be distracted about what they can do organically. So M&A may be a solution or a way to enhance the business. Is not the solution per se. We need to do everything that's possible to make our businesses more efficient and on a standalone basis, and then, through that we will earn the optionality to look at other way to grow.
Excellent. Let's talk macro a little bit, given your vantage point. We came pretty close to a financial crisis last March with the banks and the stresses there. What worries you most as rates now seem to remain high? Where do you think potential stress points might present themselves? And one area I wondered if you could tell us a little bit about is excessive government borrowing and your concerns around that as potential stress.
Well, I think that what worries me is that despite the fact that, of course, in an absolute terms, rates moved up considerably, if you look at the absolute levels are not so high, and still people have problems in potentially now, but also in the foreseeable future when debt is rolling over to refinance themselves, and they cannot really afford to have a mid-single-digit rates environment. That's probably something to be watched. So I think that the real stress in the system will come in the next couple of years as you see the borrowing done in the days of very low rates expiring or so.
And do you include governments in that, given the very demands that they face from financing the climate, the energy transition to demographics?
That for sure, but also for the private sector. For governments, of course, you have to be concerned when you basically see that some governments have to borrow just to cover cover the interest rates bill.
Exactly.
So it's quite worrying. I mean, at the end of the day, we all know that when you look at cyclical risks, there are usually things you can manage, but systemic risks are coming from two areas. Usually is residential real estate and government defaults. So one cannot escape the issue when you look at the macro risk picture to say what can really shake the system big time.
And as you look at the economies right now, would you say which way are they tilted towards?
No, right now I think that we are still in a benign environment. I think that rates are high, but it's still full a lot of money in the system. So we haven't really seen a lot of contraction in the money supply in the system. So the QT has been implemented, but it's not very aggressively. So I don't see this stress coming. Actually, if you look at valuation in the markets and many assets are still highly valued. But when I look at areas like, the latest move in gold, when I look at, the moves this year, but also the creation of cryptocurrency and Bitcoins, then I have to really think about what is going on here in the system that sends me a message that some of it may be misused, right? So when you look at cryptocurrencies, of course, people are always indicating that maybe behind that there is a speculation or maybe some, more criminal activities. But the truth of the matter, it's also probably a lot of people who are going there because they don't trust the fiat system. They don't trust the existing systems, right? So that's for me a warning signal. When I see that kind of inflation or bubble coming in certain areas, then I'm getting a little bit nervous.
And do you think that the markets are pricing accurately the geopolitical risk that we're seeing at the moment?
I think so, but it's in some cases it depends what kind of risk we are talking about. The geopolitical risk, unfortunately, when I talk from a personal standpoint of view, from a humanitarian standpoint of view, financial markets and the economy don't seem to care too much about geopolitics. I mean, if you think about the tragedy we saw in Eastern Europe, in the Middle East that we see right now, there are maybe some couple of weeks effects on markets, and then things moves on. So it's really somehow troubling, or, you know, if you think for us as a society. So I think that the geopolitical issue that can really touch markets in a severe way is an escalation into, you know, tensions that translate into sanctions and trade wars and so on, more than the classical geopolitical conflict we are used to.
Indeed, and a good segue to my next question. Just for the audience in the room, there will be a chance to ask questions in a few minutes, so just bear with me for a few more from me. You mentioned, you know, trade wars. What would a Trump presidency mean for world economies and for wealth management, would you say?
Look, we are not really honestly thinking about in that terms. You know, we have been working and adapting ourselves to different political outcomes, not only in the US, but also globally. We will need to assess exactly what is the program and what is done. So I don't think that is, we used to work, we have been working with different administrations from different parties, different presidents, including with President Trump. So we will see what the Americans...
I mean, if the trade barriers go up, you know, what does it mean for world economies? What does it mean for
Well, look,
for
you
your
know,
business?
also, it looks like there is a, you know, that topic could emerge as a topic no matter who wins.
Quite, yes.
So that's quite clear to me. So it all depends how broad it goes outside defense and technology, which seems to be the two areas where, of course, it's unlikely to see any major agreements between China and the US around defense and technology matters. In anything else, I think that I still believe that there is a mutual interest to pursue a sustainable and credible agreements on how to trade together. But, you know, look, from our standpoint of view, we are really prepared for any kind of scenario. When we look at those kind of scenarios, we always look at not necessarily what can be the trigger of a crisis or of an economic crisis, but is our ability through our balance sheet and business model to absorb any of those stress. So it's way too complicated to try to figure out the triggering point, because eventually it's not so important.
But as you look at China independently of the US and, you know, the pivot under Xi to, you know, national security perhaps over economic growth, how does that affect the growth opportunity for UBS, would you say?
I think that Asia is still, in any case, no matter if it's, I look at China as a proxy for Asia, but it's clear, broadly speaking, if China grows between 4 and 5%, it's still a pretty, you know, compelling growth on a strong base. We are really convinced that for us, the future in the next 10, 20 years, we're going to see growth in the US and Asia. And China as well, right? So I think that's, you know, I don't see this trajectory changing. Of course, as we said a few times in the last 4 or 5 years, it's going to be more bumpy. It's not the China and Asia growth we saw in the last 20 years or 15 years. It's going to be much more subject to the ups and downs, and particularly for China today, of course, the real estate bubble has to be reabsorbed. So the issue is clear that this is a huge task for the Chinese government to address, restore confidence in consumers, and you know, but you know, I think that's we are positive about the future. So and we are keeping investing in Asia, and we are growing. You know, in the first quarter, we saw also very good results coming from our Asian operation. So.
And do you think much about what you would do if you had to pick sides?
No, I think that's one of the things which we need to pay attention first as a business, but also as a relatively small country. You know, we don't need to pick sides. We need to let you know, others determine things. We don't need to pick sides.
Let's see if we have questions from the audience. Any hands up? If you can introduce yourself as well.
Hi, Billy Camberis from LSEG. Thank you so much for the great insight into what's going on. I suppose I'll be a little bit greedy and I'll ask two questions, if I may. The first one is on non-core and legacy. Do you foresee a situation whereby by 2026, potentially some of the assets that you've thrown in there may become core and actually you keep them, or is that black and white, they're all being run down? And on the second one, notwithstanding the fact that everything that's remaining, both technology, processes, etc., as you mentioned, is going to be UBS first approach, from your experience in the last sort of few months now to a year, has there been something that Credit Suisse used to do better than UBS and that you're potentially keeping?
Of course, you know, first of all, let me address the first question. So today we have non-core and legacy assets accounts for 11% of our risk-weighted assets, including a good chunk is operational risks. By the end of 2026, we expect this number to be 5%, around 5%. So half of which will be up risk. So you can see how, you know, how small that numbers will be. I think that's as time goes by, this is natural attrition only, without us taking any proactive actions on reducing. So natural decay of the assets leads us to 5%. So I'm pretty convinced that we're gonna be able to manage that one. You know, they are, first of all, they are non-core assets. They are not necessarily bad assets. So some people somehow erroneously describe them as a bad bank, which has, you know, it's nothing to do with a bad bank. They are simply not core assets to our activity. And therefore, we also don't feel the pressure to sell it at any price. For us, the most important topic around non-core is, in some cases, as time goes by, we may have an advantage to dispose assets if they allow us to shut down systems and infrastructure that supports those assets. That's a real economic value creation in the exercise as time goes by. So I don't think is I would be very happy for this to be our biggest issue in the integration. So in respect of course, we are embracing new people, new ideas, in the way Credit Suisse was running their businesses, try to implement it into our business. Short term, we have a conflict because speed and efficiency is very critical for us, and therefore debating too much around perfection may lead into unwanted outcomes. But we are keeping an eye on, as I said before, and maybe it's not a lot, but we are keeping 300 applications out of 3,000 because we believe they have a better value than our own, or they are necessary to support some of those businesses. The most important issue that we want to keep is the people. Because we can argue about processes being good or bad, but if people are good, we're always going to have, over time, better solutions. So that's my focus as we go forward.
Other questions?
Thank you very much. We touched on this earlier, but I was listening to a podcast that you did about a month or so ago, and just building on the point around the importance of people. You talked about culture and the importance of people feeling that they were now playing for the national team and reframing how they think about that, which I thought was brilliant. I thought that was a really great perspective. Can you share with us a little bit about what are the attributes of the leaders that you think are going to be really important to really build a culture that you want going forward?
Well, the attributes, I take out the technical attributes, because of course nowadays is, of course, if you are a leader or any you have almost any function in any business, in any organizations, you can't go away from that. To me, it's always the same, is leading by example. I mean, the real issue is that it's very difficult to ask other people to do things if you are not seen. It's not just prepared to do the same, because prepared is fairly theoretical, right? You have to be seen doing the same. You have to really, in any dimension, being the way you approach, how you deal with clients, how you deal with colleagues, how you deal with a success and failures, how you react to that. So it's really very important, because at the end of the day, I'm convinced that running any function, but particularly the more in more senior position, leading through authority, doesn't take you very far. So and the most important issue is to lead by example, in my point of view.
Talk about leadership. I would be remiss if I didn't ask you. Eventually, I imagine you will leave UBS. I wonder, what kind of manager do you think needs to succeed you? What kind of manager will UBS need after Sergio?
Well, I don't know.
A deal maker?
It's not maybe, I don't know. I mean, it's in any case, it's, I made a commitment to the board to stay at the very least until integration is finished. So that means end of 2026, early part of 2027. So we the issue of succession is not a top priority. Of course, every year we go through the succession process, really look at making sure that we have a proper set of candidates that can step in with different characteristics, and those characteristics may then play a role at that point in time in being the right person at the right moment. So our goal is to really increase dramatically the chances that we can have an internal candidate to do that. My commitment is to present candidates internally, so like I did last time. So then, of course, so that's, but at the end of the day, it's going to be a decision of the board what to do.
I know you're concerned any of them might leave to a competitor. I know one of the big banks is hiring at the moment.
I'm much more concerned if people don't want my people than if they are.
Fair enough.
Yeah.
Any other questions in the room? One here.
Thank you. Henrik Siebert from Swissblock. I want to get back to your the question, what worries you the most in terms of macro? And you were talking about this with the spike in rates and how that affects consumers and also your customers. What are your outlook in terms of a potential global recession, and how would that potentially affect UBS at the stage of the integration that you're in at the moment?
Look, I mean, yes, rates. I think that maybe if I expand for a few seconds on that, of course, rates won't come down if the inflation is not under control. And if there is one issue that worries me, is that if inflation doesn't come down, I really see not only an economic consequence, I also fear a social consequence, because I would say no matter when you look at in the US, in Europe, across the around the world, you know, inflation is eating into the purchasing power of the middle class in a big way, and I do believe that this situation is not sustainable. You know, you would lead into social unrest and so on and so forth. So that's probably more impactful than purely a cyclical recession. In some cases, you know, if a recession would come, you would even say, so welcome, because obviously in the last few years, we avoided recessions at any cost. And by doing so, I think that we created some of the problems we have today. So the way it's going to impact us, you know, we can never be complacent, but we have one of the pillars of our strategy is to have a capital and a balance sheet for all seasons. I mean, we are really constantly planning our worst case scenario and stresses around that. So I'm not too concerned about our ability to execute on the integration. That's a separate topic. And when I look at our resilience, I'm fairly convinced that we can, you know, manage any kind of situations going forward. Of course, that means that we need to absorb the second order effect on our clients for such a recessions, no matter how it's triggered, to, you know, Swiss economy, to our wealthy clients, and so on and so forth. You know, I would say that in moment of crisis, on the other end, on the more positive side, I'm not looking for that, but I can, you know, statistically, the empirical evidence seems to show that in moment of crisis, we are a safe haven. And that's the reason it's always very important for us to maintain that strength, because, you know, the real winners comes out of difficult moments, not in good times.
Now, we could probably talk for hours, but we probably have just time for one more question from me, if I may. You've talked a lot about the need for consolidation in European banking, right? And, you know, the need for banking union in Europe to facilitate that. But just in the last week, we saw quite a rare event. We saw a European bank going hostile on another European bank. It's domestic, so not the sort of types of deals perhaps that we need. But I'm just curious, are we going to see more animal spirits being awakened by this deal? And should we be expecting more of these to come? And should they?
Yeah, I'm not going to comment on this specific transaction because we are advising one part, so I think it would not be appropriate for us to comment. But what I can say, generally speaking, is that I've been talking about, in my point of view, the need of consolidation in Europe.
But do the numbers stack up now, do you think, for more of the, I mean, because for 1 or 2 years it was quite difficult to do any deals, right?
Yeah, I think that if you look at, this is yet, you know, in this specific situations, is a continuation of the domestic consolidation. So it's not really what eventually Europe needs, right? I think but it's going to be very hard to achieve a European consolidation without banking union and a proper framework. But domestic consolidation is still possible within Europe. There is still a lot of banks and inefficiencies in the system. If I can make only one comment around, I will want to make only one comment around this announced transaction. I think it's positive to see a transaction being triggered by an industrial logic rather than somebody having to step in to rescue somebody. No, because usually if you look at Europe, it's all about M&A driven by rescues. And that's not good. There has to be a way over time to develop something that is not triggered by a crisis.
So do you think it might awaken those spirits and could we see more?
We will see. I think that's, in my point of view, it's a journey and like I say for other matters, it's probably more a marathon than a sprint.
Excellent. Well, thank you very much. Thank you, Sergio. Thanks to the audience. I'm afraid on that note, we're going to have to leave it there.
Thank you.
Thank you very much.